And as always, we're going to be looking for accurate context, good risk management, and always exercising good patience.
Everybody who's traded has gone through periods of time where their strategy hasn't worked.
Where if not a hard stop, you should reevaluate the trades you're in based on time.
That's what we're here for, is to put ourselves in the best success. A trading routine does that, builds that habit, lets you know what to work on, what to reflect on, and what to improve on the next day.
Hello, friends and traders. Welcome to the Coach's Playbook. Here we are, the Topstep coaches, here with John Hoagland, Mick Aronimo, Dan Hodgman. I am JD, filling in for Jack today. Hope everyone is having a great day. Today, we're going to be talking about some of the more common pitfalls in futures trading, or how not to trade futures. But before we get started, Mick, I hear you've got a Funded Trader shout out for us.
I have a shout out, big shout out to Philip Shadlow, up about 2,100 trading the NASDAQ this morning.
Very excellent. NASDAQ's the hot ticket item this week.
Everybody's trading it.
It's moving. It's scary to me. I don't trade it. But
I'm with you
anyway,
there.
So there are a lot of common pitfalls when it comes to how not to trade futures. One obvious one, over trading. There's a lot of reasons that we do overtrade. FOMO is a big thing, revenge trading, just being impatient also. So why don't we start with let's start with Dan today. What are your thoughts on how to overcome some of the more common pitfalls?
Let's keep JD around a little bit. So I think the first and foremost one that comes to mind is, and it's going to sound a little weird, but people come into trading and they're just trading to make money. And don't get me wrong, I'm 100% in this industry to make more money, but your trades cannot be determined based off of how much money you want to make. You need to really focus on your process. You have to define this process. You have to really work through this process. It's going to take quite a bit of time to get to a point where your process is going to be profitable. But over time, with education, with working through things, with back testing, that process can then become profitable. But if you come in this with the idea, and this I see it way too often with new traders coming into the program, or new traders that I meet outside of here, they want to be the next Gordon Gekko. They want to be that next millionaire. You see it, you glorify this idea of what Hollywood has created as a trader. And that's a justification to get in this. And I don't have anything against that, but you need to be realistic with yourself. You got to come in and really be willing to put in that work, focus on that process. And over time, that process is going to lead to profits. If you're trading strictly to make money, you're going to have a really difficult time because all you're thinking about is the dollar value. And again, I'm here for money. I trade to make more money, but that's not my approach when I'm entering into a trading day or into any given trade.
Awesome.
Yeah,
Thank you.
I really like what you were saying there, Danny. I couldn't help but think about, there was on our blog, there were some rules that I put down, like old school rules that still hold true. And one of those was separate your desire for profits from your trading. And John says it well, money is a byproduct of good trades. So I'm happy you brought that up. And I'll let JD dish it out to whoever's next.
We also did a great podcast with our friend Dr. Andrew Menaker a couple of years ago, who preaches process over process. I'll link that in the article for this video later on also. Hoag, what are your thoughts?
Okay. Well, I mean, we all came from the trading floors, and I know we've all seen people do this. To me, one of the most detrimental things that a trader can do is to average into a losing trade. I've seen people buy it at 8, buy more at 6, buy more at 4 to bring their average trade price down, buy more at 2, and when it's going down through even, they're getting taken out of the pit because they've lost all their money. I've seen it happen. It's never pretty. Now, this is different than accumulating a inventory in a zone, but when you find yourself unable to admit that the trade is a loss, trying to lower that average trade price so that maybe you can get a pullback to get back to even, you know you're in trouble. The market is rarely going to give you that opportunity to get back to even. It may tease you with it, but then you're going to be buying more cheaper and buying more cheaper. And when the market takes you through that level that you just can't take that pain anymore, you're going to be puking out of that trade. It's one of the most dangerous things to a trader that I've ever seen in my life. And again, I've seen it over and over, live and in person. And you see that a couple of times and you basically say, you know what? I am never going to do that. Because
I'm glad you brought up the difference between averaging in and having a strategy for buying in as the price goes lower, because it's two hugely different things.
Absolutely. Because in the latter, where you're accumulating a inventory in a zone, you have a level where the trade is no longer valid. If you're just trying to lower your average trade price to get out of a huge losing trade, that's when you're really in trouble. And in the pit, we could see the guys that were doing that, and we would stand over next to them because for sure, when he puked out of that position, it was going to be either the dead low or the dead high. We were waiting for that to happen. Not really a nice thing to do, but if somebody's going to make that money, it may as well be us.
Yep. It's trading on ego, nothing else. That's basically it. I couldn't agree more with you there, Hogue. The cannonball used to be one of my favorite trades too. And you're exactly right. You're either puking the low or dumping the high, and it was a horrible way to do it. What do you have to say, Mick?
There's a lot of pitfalls out there. I think we've touched on some good ones. What I'm going to share are my biggest F-ups or my screw-ups. And it's two things. One, having an extremely strong bias, thinking that the market should be doing something. I had a very strong bias early on in my trading with, it was a short bias in the soybeans. Those of you that have watched these videos, I know I've talked about it a couple of times. I just, I was so bearish and I went in, I was shorting the market every single day, thinking it has to go down. And it just proceeded to rally. And I took some time off from trading during that time. Beans continued to rally, so I'm glad I got out of that. But I had a super strong bias, and I missed out on, that China was just buying tons and tons of our soybeans, driving the prices up. So that was one big screw up, overly strong bias. And then the other one was over leveraging. Years ago, I had put on the biggest position I'd ever had on. It was way too many contracts for me to be trading, and it went against me. And it was a really nasty loss that set me back. And, I wiped out a lot of hard work, not just days, but weeks and months of hard work on this big corn position that I had. So the two ones that I'll say, don't have too strong of a bias. It's good to have a bias, but don't have too strong of a bias. It can put you out of business, like it almost put me out of business. And then over leverage, it's like John says, you never have enough on when it goes in your favor, and when it goes against you, you always have too much on.
Always have too many.
So trade in your comfort zone. Trade smaller than you can, unless you're obviously adding to a winner or something. And those are my two that I want to share here today.
Awesome. Thanks, Mick. Yeah, I think the easiest thing to do is also the hardest thing to do when you start feeling the market slip away from you. Just get out and then get up and walk away for a little bit. Some people have such a hard time doing that. I understand. I had a hard time learning how to do that myself.
Mick, when you're talking about holding a bias, I mean, we all have a bias or a hypothesis of what we think the market's going to do. It's difficult, especially when the trade is on, to accept information that may be contrary to what we think. We tend to discount those thoughts, but it is of ultimate importance to accept information and be creative. Because if the market's telling you you're wrong, the market's telling you you're wrong. You got to be able to adapt to that. And and again, it's not easy because we don't get any smarter once we're in the trade, of course. But just being accepting of contrary information is vital. I mean, I had a strong bias today, and it's playing, but if my strong bias was going the opposite direction, I'd have to cut it off at some point and say, not my day, not going to fight this.
Yeah, you have to balance having that bias and with knowing that anything can happen and that you can be wrong. I mean, I think the more times you find you're being wrong, the easier it is to say, anything can happen. I'm not always right.
Yeah, if we had badges now, I probably would change my badge to ACH. Anything can happen.
Well, it's kind of funny. It's like trading is full of guys with big egos. And I think a lot of traders get into this with an ego. Like, I'm going to make money. I'm going to be successful. I'm going to do really well. And going off of what Mick's talking about here, it's not always about being right, but it's rather about being profitable. And I think the young, the rookie, the beginning trader comes in with the ego is saying, I've got to be right. And as you start to get your, stuff kicked in pretty good over time, you start to realize, hey, it's not about being right, it's about being profitable. And my ego can get a hell of a lot bigger boost of being profitable as opposed to saying I was right. And at the end of the day, that's something you have to have the humility of within yourself to say, hey, you're not right here. Get out of this, make some of the adjustments as needed. And then you can boost the ego and tell everyone how much money you made if that's what gets you excited about things. But at the end of the day, it's truly about making those profits and not being right. Because a lot of times I can tell you, I make money being wrong because I said one thing, but the market told me something else, and I traded what the market did, and I made money doing that. Had I done with what I thought was the right thing sometimes, or what the thought the market was going to do, comes back to bite me in the face.
For sure. These markets will humble the biggest egos very quickly. Got to know how to take a loss, admit when you're wrong, and try and turn it around.
Mhm.
Great words of advice, guys. Dan, you got a quote to close us out with?
I do. It comes from Albert Einstein. I kind of like this one. A person who never made a mistake, never tried anything new.
Good one. Good one.
I
I like that.
He's a pretty smart guy, and he did come visit my hometown of Lake Geneva, Wisconsin, way back in the day. There are pictures of him around, so we're like buddies at this point.
But you go to Yerke's Observatory?
Yes, we did.
Hanging out at Chuck's.
Right.
All right, everyone.
Big drinker, Albert. Big drinker.
All right, guys. Well, thanks for joining us today. We'll see you next time. Have a great day, everyone.
Trade well, everyone.